Hi, everyone. Welcome to my webinar. My name is Allison Kirchhoffer. In this three-part series, I'll be talking about cannabis accounting and best practices to minimize taxes. In part one, we'll have an overview. In part two, I'll dive into an example. And part three will provide some best practices and food for thought. I hope you enjoy this content, and I encourage everyone to spread some internet karma with a like, share, and subscribe. A little bit about me. My passion is for small business, which is where I have spent most of my career. I've developed an expertise in building up accounting departments from scratch and implementing standard operating procedures for bookkeeping. I have a background in restaurant accounting, which has prepared me for many of the challenges faced by cannabis companies, including cost accounting, cash handling, and software reconciliation, just to name a few. I love the cannabis industry, though, not only because it is truly interesting from an accounting perspective, but also as I learn more about the history of prohibition in America, it is becoming more and more important to me to see cannabis return to the forefront of society where it once stood. So my mission as a CPA is to support and educate the trailblazing entrepreneurs in the cannabis space by providing world-class accounting and tax services that propel their businesses to grow and thrive in this regulatory environment. So you own a cannabis business, most likely if you are listening to this webinar, or you're thinking about it. Congratulations, you're going to be audited. Just expect it from day one and plan for it. Have rock solid accounting in place and a permanent audit trail so that auditors get in and out quickly with minimal questions. So let's begin with some definitions in tax and accounting to provide a foundation. The two tax code sections that impact our discussion are 280E and 471. 280E was designed to put companies out of business. THC companies cannot take typical business deductions. And I will use the phrase THC to distinguish from hemp and CBD, which is legal, so 280E does not apply. So, what options does a state legal cannabis THC business have? Some may choose to utilize the provisions in Tax Code Section 471. We'll dive into the details in part two, but here I'll just say that the application of 471 must be done properly, accurately, consistently, and reasonably. And now some important accounting definitions. GAAP stands for Generally Accepted Accounting Principles. In other words, good bookkeeping according to the Financial Accounting Standards Board and the SEC. P&L stands for profit and loss. It is a financial statement that shows profitability over time. So here you will find your revenue and expenses. The balance sheet is a financial statement that shows the value or health of a business at a point in time. So here you will find your assets and liabilities. Inventory is product. It's either in production, in which case it's referred to as work in process or WIP, or it's finished goods. Inventory is an asset on the balance sheet. When inventory is sold, it moves to the P&L as an expense called cost of goods sold, or COGS. So a little bit more about what is cost of goods sold exactly, since it is the crux of 471. An easy way to think about COGS is that it is all of the direct costs associated with producing something or providing a service. From a tax perspective, it is an adjustment to gross receipts, not a deduction from gross receipts. So if you recall, 280E says that THC companies cannot take any deductions. Well, luckily, COGS is not a deduction, but rather an adjustment that lowers taxable income. So before we get into part 2, I'll end here with just some of the key takeaways. Proper accounting can maximize the benefits of 471. And accurate inventory counts will lower your taxable income. In other words, knowing your inventory numbers will maximize COGS and decrease your tax liability.